The most dangerous man in the Sinaloa cartel wasn't carrying a gun. He was carrying a spreadsheet. And when American authorities finally caught him, they didn't find weapons. They found ledgers, thousands of pages of financial records, so detailed, so precisely maintained, that prosecutors said it was better bookkeeping than most legitimate businesses they had ever seen. This is the story nobody tells you about organized crime. The violence is the distraction. The money is the machine. And the machine needs someone who understands numbers far more desperately than it needs someone who understands weapons. So let's follow the money, every dollar of it, from the moment it's earned on a street corner to the moment it comes back clean, legitimate, and completely untraceable. Because what you're about to hear is not a crime story. It's a finance story. And finance, it turns out, is the most dangerous weapon a cartel has ever found. The problem starts the moment a cartel makes its first dollar, and cartels make a lot of dollars. The United Nations Office on Drugs and Crime estimates that global drug trafficking generates somewhere between $400 and $500 billion annually. The Sinaloa cartel alone, according to the DEA, generates revenues estimated at $3 billion per year. The Zetas, at their peak, were pulling in similar numbers. These are not street-level operations scraping together rent money. These are industrial-scale revenue machines. But here's the problem that nobody in a ski mask ever thinks about when they're dreaming of running a cartel. Cash is heavy. $1 million in $20 bills weighs approximately 50 kilograms. The Sinaloa cartel at its height was moving so much physical currency that they employed dedicated teams whose only job was counting money. Not spending it, not investing it, just counting it. Because before you can do anything with criminal money, you have to know how much you actually have. And knowing how much you have requires someone who can count accurately, consistently, under pressure. That is not a hitman's skill set. That is an accountant's skill set. But the counting problem is actually the easy part. The hard part, the part that has destroyed more cartels than any law enforcement operation in history, is what you do with the money after you count it. Because cash, at this scale, is almost impossible to use. You cannot deposit $3 billion in cash into a bank account without triggering immediate federal scrutiny. In the United States, any cash transaction over $10,000 automatically generates a currency transaction report filed directly with the Financial Crimes Enforcement Network. Banks are legally required to file suspicious activity reports for anything that looks unusual, even below that threshold. So the cartel's money is essentially trapped. It exists, it's real, but it cannot enter the legitimate financial system without leaving a trail that leads directly back to the people who earned it. This is where the accountant becomes more valuable than any soldier, any smuggler, or any hitman the cartel has ever employed. The process of solving this problem has a name: money laundering, and it is far more sophisticated than most people realize. The term itself comes from Al Capone's era, when criminal organizations in Chicago used cash-heavy laundromats as cover businesses to blend illegal income with legitimate revenue. Capone's operation eventually collapsed, not because of his violence, but because of his taxes. In 1931, he was convicted of tax evasion, not murder, not bootlegging, not racketeering, tax evasion. The federal government couldn't prove the crimes directly, but they could prove the money didn't add up. That lesson, that financial exposure, is the most lethal vulnerability a criminal organization has, was learned by every serious organized crime operation that came after him. And the ones that survived longest were the ones that took accounting the most seriously. The modern cartel money laundering operation works in 3 stages, and each stage requires a different kind of financial expertise. The first stage is called placement. This is the most dangerous moment, when raw, untraceable criminal cash first makes contact with the legitimate financial system. The most documented method in the Western Hemisphere is called smurfing. It involves breaking large sums of cash into deposits small enough to avoid triggering currency transaction reports, then using networks of individuals called Smurfs to deposit that money across dozens or hundreds of different bank accounts simultaneously. The Cali cartel in Colombia during the 1980s and 1990s ran smurfing networks so large they employed thousands of individual depositors across the United States, each one making small deposits into accounts that were later consolidated and moved. But smurfing is labor-intensive and increasingly detectable through pattern recognition software that modern banks are required to use. So cartels evolved. One of the most elegant placement mechanisms ever documented was the black market peso exchange. It worked like this. A Colombian cartel sells drugs in the United States and collects cash in dollars. Instead of trying to move those dollars back to Colombia, which is physically dangerous and legally risky, they sell those dollars at a discount to a Colombian money broker. That broker then uses the discounted dollars to buy American goods, electronics, appliances, luxury items, which are then exported to Colombia and sold for pesos. The cartel receives clean pesos in Colombia, the American goods exporters receive payment and never ask questions. The money broker profits from the exchange rate discount, and the dollars never officially leave the United States. The Financial Crimes Enforcement Network has called the black market peso exchange the largest money laundering system in the Western Hemisphere. Billions of dollars moved through this mechanism for decades. It required no guns. It required currency traders, import-export brokers, and people who understood exchange rate arbitrage. The second stage is layering. Once the money is inside the financial system, the goal is to make it impossible to trace back to its origin. This is where the financial sophistication required reaches levels that rival legitimate investment banking. Shell companies are created in jurisdictions with weak disclosure laws. Historically, Panama, the British Virgin Islands, Delaware in the United States, and until recently, Cyprus. Money moves between these entities in transactions that appear to be legitimate business activity: consulting fees, licensing agreements, loan repayments. Each transaction adds a layer of distance between the cash and its criminal origin. The Sinaloa cartel's financial network, when partially dismantled by U.S. authorities, revealed shell company structures spanning multiple continents, with money passing through entities in Mexico, the United States, Europe, and Asia before returning in a form that appeared completely legitimate. One documented case involved a cartel-linked financial network that moved over $2 billion through a major international bank before being detected. That bank, HSBC, was fined $1.9 billion in 2012 for facilitating the transactions. The fine was significant, but no individual banker was criminally charged, which tells you something important about where the line between legitimate finance and criminal finance actually sits. The third stage is integration. This is where cleaned money re-enters the economy as apparently legitimate wealth. Real estate is the most common vehicle. In Miami, during the 1980s cocaine boom, entire neighborhoods were purchased, with cartel money moving through legal real estate transactions. Cash purchases of property require no bank financing and historically minimal documentation of fund origins. Luxury goods, art, jewelry, yachts serve the same function. A painting purchased for $2 million in cash, held for 2 years, and then sold through a legitimate auction house produces $2 million in documented, taxable sale proceeds. The criminal origin of the original cash is now completely obscured. The art market specifically has been flagged repeatedly by financial regulators as one of the least scrutinized sectors for money laundering in the world. As recently as 2020, the U.S. Anti-Money Laundering Act began extending reporting requirements to art dealers for the first time, decades after those same requirements were applied to banks. Now, here is the twist that ties this entire story together, the part that reframes everything you just heard. The cartels did not invent any of these mechanisms. Shell companies in low-disclosure jurisdictions were created by legitimate businesses seeking tax advantages. The black market peso exchange evolved from entirely legal currency trading practices. Real estate as a wealth storage vehicle is used by legitimate investors everywhere. Art as an unregulated asset class benefited everyone from hedge fund managers to museum endowments before it benefited cartels. The financial architecture that cartels exploit was built by and for the legitimate global economy. The tools of cartel finance are identical to the tools of legal wealth management. The only difference is whose money is moving through them, which means the accountant sitting inside a cartel operation is not some exotic criminal genius operating in the shadows. He is doing the same work, using the same instruments, reading the same regulations as his counterpart in any major financial institution. The violence is what makes cartels visible. The accounting is what makes them survivable. And as long as the financial system contains the mechanisms it currently contains, and as long as the incentives to look the other way remain what they currently are, the accountant will always be worth more to a cartel than the hitman. Because hitmen can be replaced in an afternoon. A good accountant, as the Sinaloa cartel learned when their chief financial operator was finally arrested, takes years to replace. And in those years, everything falls apart.